Hey guys, Ken Calcutt here with Cornerstone Financial Management. Just wanted to give you an update on what's going on in the markets. It is mid-October. It's been about 6 weeks since we did our last update to you guys, so a lot's changed. I want to start with where we kind of left off last time. At last meeting, we were here. This chart we're looking at is the S&P 500, just general stock market movement. Right here was the time we did the video at the end of August. Okay, the market was right here. And I had mentioned in that video, I thought we might see the markets go lower. September is normally a volatile month, and sure enough, that's what we saw. We saw markets go lower here through September, but I was hopeful that we would see support here at around 4,200 for the S&P. That's roughly the 200-day moving average, and that is exactly what we saw. Throughout September, we had a pretty nasty drop in the stock market. Last week, we saw support here around 4,200, and we've had a decent little bounce here in early October, coming off of that 200-day. So what we're seeing now, this line we have drawn across the screen, this is a trend line, and this is showing the low points we've had in the market from October of 2022, here again in March when it pulled back, March of 23, and then last week. What we're seeing is a clear pattern. This trend line seems to want to hold, which means the trend of the market tends to want to go up and to the right, which is what we want to see. I'm encouraged that we saw support here last week. It gives me a little more confidence that this might be a long-term bull market, and we see support when we hit the 200-day. All right, so one thing I want to point out here, this has been a decent stock market year, 2023. But we need to be mindful that the primary reason we've had a great year in the stock market or a good year in the stock market, it's really only a handful of stocks that are responsible for that. So when we look at the S&P 500, it's what we call a market-weighted index. So larger companies have a bigger influence on the movement of the index. And so companies like Apple and Microsoft and Amazon and Google, these giant companies, when they move 5%, that has a much bigger impact than smaller companies moving 5%. Now, what we've seen this year, what they call on the news, if you've probably seen this, called the Magnificent Seven, is what they're referring to it as. There's 7 stocks that have had fabulous years, and they're all giant companies. So when 7 giant companies in the index have big years, the index looks fantastic. The reality is 490 of the stocks in the S&P have not had a fantastic year. They've been very average, very flat if you take out those 7. So while this is encouraging news and we've had a positive year, the bulk of that growth is attributed to a very small number of stocks. So we're not seeing the entire stock market look really good. We're seeing a small number of stocks look fantastic and the rest of the stock market look okay. So I'm hoping that will improve. I'm hoping we'll see the rest of the stock market start to improve and catch up and have more positive numbers going forward. But that's what we're seeing in the market overall. So that's good, but what we're really watching here, I want to show you one more thing. This is what we're really watching. This is the 10-year Treasury yield chart. This is showing us basically the interest rate on 10-year Treasuries or 10-year bonds. What you'll notice with this chart is the interest rate on bonds from July to now has gone up pretty noticeably. During that same time frame, we saw the stock market go the opposite direction. The market is very interest rate sensitive right now. We are still in an environment where we're trying to figure out inflation. We're trying to figure out how high the Fed's going to go with interest rates. And the higher the Fed goes on interest rates, the more difficult it's going to be on the economy and on the stock market. And so we had this unexpected rise in 10-year Treasury yields, which caused the stock market to sell off August and September. So what we're hoping the 10-year Treasury is going to be done around 5%. You can see here it's at 4.71 this morning. I'm hopeful that 5%, give or take, is going to be the high point, which means that if rates don't go up above that, I would expect bonds will not have much more struggling ahead of them. They'll start to recover from there. The stock market likely would continue to improve. If the 10-year Treasury goes much higher than 5, we're probably going to see bonds and stocks go lower. I think they're going to be sensitive enough where they would go lower if we saw the 10-year Treasury go above 5. So we're not out of the woods yet on this. I am encouraged by what I'm seeing with the stock market with this uptrend that we went over. That does seem to be a pretty solid new trend pattern that's been in place for 12 months now. But I am still concerned with the Treasury yields and what the Fed's going to do with interest rates. I am hopeful that they're done raising rates. There's a lot of economists out there and analysts that feel like they're probably done. I think they're very close to done if they're not. And so we're just going to have to watch it and see. what we're doing with the portfolios, we are starting to shift a little bit back towards a little bit more aggressive for the most part. We've been leaning more defensive for the better part of a year, and now we're going to start leaning back because we're starting to see things that are a little bit more encouraging, a little bit more upside potential, especially if the Fed's going to be done raising rates. So those are the things we're watching. There's a lot of moving parts to this market. This is probably one of the more complex markets we've seen in a very long time, but there is some encouraging pieces to it. And so I want to give you an update. That's what we're seeing right now. If you have any questions, feel free to reach out, call or email anytime. Thank you.